they're only going to invest in 100 funds. And so when they have that kind of bandwidth issue, it's very hard for them to invest in niche strategies because almost all capital providers are measured against a benchmark. And I've been told this directly by the capital providers. It's like if I invest in niche strategy A, then I've got to invest in 15 niche strategies to match what might happen at the benchmark. And I don't know how to allocate. I don't have the bandwidth. I've got to, attend my meetings and do everything that I do on my side. So I'd rather invest in the large funds because they'll give me the 15 strategies. So even though it's sort of out there like, hey, people invest in large funds because they never get fired by investing in large funds, we actually think that there's this more core fundamental reason that people are investing in the large funds, that they don't have the bandwidth to really understand many small funds. And then on the direct deal side, what we feel is that now, I just saw something, a fund looked at 500 deals and did due diligence on 100 and invested in 3 last year. So the intermediary process is not what's going to get you a deal. This idea of relationship transfer is not what's going to get you capital, we don't believe, when there's that kind of tight bottleneck. And when you're talking about the fiduciary market, there are many people involved in that decision-making process. So almost all these fiduciaries get judged on how many proprietary deals did you invest in. So they want to see the deals directly from the capital seekers. But to get through that funnel, you have to be prepared and you have to know how to close. So we're in no means saying the intermediary has no role. We're just saying the role is in preparation and in closing, and is less about this idea of relationship transfer in these current market conditions.
Great. So, Suzanne, are you seeing something similar? How do you feel when you look from perspective from the family office side?
Yeah, so I would agree with what Mary Beth said, that I think relationship transfer has changed, right? The relationships you have with the people that are allocating capital are way less important today than they were perhaps back in the day. You have to have all of your ducks in a row in terms of, to your point, what you present. You have to be totally buttoned up on the back office side, right? Because operational due diligence didn't exist before Madoff, right? My father, who's passed, but when he was alive, he did most of the investing for our family personally because his background was Wall Street. He was a trader. He could look at strategies and understand. And post Madoff, I remember saying to him, Dad, if I don't have a client that's invested in one of these funds that's done the ODD, we're not doing this. So that business has obviously grown tremendously in the last 15 years and is a big part. So like when we look, one of the things that we bring at the fund is, we've been registered with the SEC. We've had an SEC audit. The team has been together a long time, so you don't have to worry about them getting divorced. I do think one of the issues with capital providers these days is a lot of the endowments and foundations, particularly, are upside down. The denominator effect that you've heard ad nauseum. And so while I agree with the point that some of the larger institutions are covering their ass by investing in bigger managers with different strategies, they're doing that because it smooths the operational side of the due diligence. Once you've underwritten Oaktree, right, you don't need to underwrite the firm again, right? You just have to underwrite the fund, and that becomes a very different process for people. That said, I personally think it's a terrible way to invest. The OCIO we use in our family office is, one of the things I loved about him, and he was a client of mine before I became a client of his, so I really understood the way he thinks and the way he does due diligence and looks at managers. We don't do any mainstream funds. If you looked at my sheet, as they call it, every month, you would see things you've never heard of. Doesn't mean the strategies are that different than what some of the larger players might be doing, but we think they're done by more nimble, more entrepreneurial, thoughtful managers who are more in the asset management business and the asset gathering business, right? One of the things I think to think about when you're allocating to funds, and this is true whether it's private equity or long short equity, on the sort of other end of the spectrum, is that look at the structure and understand if the structure of the product you're looking at matches the underlying investment and the underlying liquidity of that investment, right? A long short equity guy who wants a 2-year, who's trading in large caps, who wants a 2-year lock because everybody knows his name, that's great, but I don't particularly like investing that way, right? If you're that liquid, I should be able to have my money when I want my money. And so I would look at the structures and how they're, we're lucky today because right prior to Madoff in 2008 and all these different things, you were a hedge fund, which meant you were quarterly liquidity, or you were a private equity fund. And that doesn't really jive with a lot of the underlying strategies. Do I think Izzy Englander, who I've known my entire life, should have a 5-year lockup? Absolutely not. I redeemed, despite the personal relationship. I want to see that alignment of the manager and the underlying assets. And I think it also helps when you're thinking about how do managers blow up? Well, often it's style drift, right? But if the structure reflects the strategy that the manager is employing, you have less of a risk of that because they're not pressured by redemptions or other things that are outside their control.
Mary Beth, what are you seeing?
Yeah, just to build on what Dianna and Suzanne has seen. So I work with niche strategies. Most of the managers I work with are small, under 300 million. I think relationships matter. You do need to have all your I's dotted and T's crossed and whatnot with your operations and your risk controls. But getting in the door when you have a first fund or a second fund, it's really about who your past relationships are. You do still need the skill set to close, to cross the line, but people are bombarded with opportunities, as you all know. Going on to we had a collaboration call at Castle Hill yesterday, and we've been noticing some longtime allocators losing their jobs. And we suspect it's because they're taking the safe bet and investing in the bigger funds that are not returning the performance that alternative investments should. And the ones that are going to stay in their seat are the ones that are going to take the risk, because with treasuries going up in price, you can make pretty decent money with no risk on. An alignment of interests too, like how much did the manager invest? How much does the team invest? Is the team paid? I'm working with small funds, like some of them employees aren't paid and they're on their website. Like call the employees, like do you go and work with them and talk to them every day? I've seen it too many times and it's a thing for me, but I feel like people just assume, oh, you have 10 people that work for you, are they paid? Semper, for example, their chairman has 15 million invested in the fund, so that's a substantial amount of assets for their overall AUM. And I think that is a good sign that they're committed.
I would agree with that. I mean, our principals are putting in $25 million to the new vehicle, which we hope to launch in the beginning of the year. And I agree with that. And just to add, I do think relationships are important to get in the door. It no longer makes the sale. Doesn't necessarily help you one versus the other because, everyone's gotten so concerned. I mean, right, the public pensions, for example. I remember when I was a partner of the hedge fund that we sold, we had lunch catered every day for the entire team. And we had a big state pension come in for a final due diligence meeting. And we said, we're not ordering a special lunch. And by the way, we give the leftovers to the church next door. So, they paid us for lunch. The guys walked out and handed me $100. There were 4 of them. I looked at my managing partner. I said, what do you want me to do with this? He said, I don't care, give it to your secretary. But it was, you can't really schmooze the way you used to. But I want to go back because I didn't finish my point on the denominator effect to the point of allocators being, if you think about endowments and foundations who have to pay out at least 5%, right, by government regulation of their endowment, you're the CIO of a large university endowment, and you know that your public book has already been marked down here, but your private book hasn't been marked. So your AUM at your June 30th audit date or whatever it is skewed, and you still have to pay out that 5%, even though you, the chief investment officer, know you have capital calls that you haven't funded yet, you haven't gotten the capital back as quickly as you expected it to, and you're paying out more than your AUM to be because those privates aren't marked, and that's tying a lot of people's hands.
Makes a lot of sense.
Yeah. I was just gonna say, so we're not telling small funds that you shouldn't try to raise capital. What we're saying is that you cannot market time capital raising. And so many people wait till FOMO, right? They wait until the sector is hot and then they start capital raising. They're like, we hear that somebody's raising capital, that capital's flowing in the sector. And it's the people who've been talking to them for 2 to 3 years that are getting the capital. And so we think that the way to raise capital in this market and going forward, honestly, we think the liquidity situation, if long-term liquidity in alternatives is X and it was 5X, now maybe it's minus 1X, but it's going to go back to X. It's not going to go back to 5X because of these fundamentals that I'm talking about. And when liquidity is X, I'm sure at one point mutual funds were an interesting asset class and required a lot of education. And so we're not saying alternatives are gonna get to where mutual funds are, but nobody would start a mutual fund company and believe that they can just walk into somebody's office and get capital tomorrow. They believe that they need to do marketing, they need to be building their brand, they need to be building their brand recognition, and they need to be consistently in front of these potential capital providers. And that's the way we're saying that capital seeker.
And that's the great riddle of the hedge fund business, is that so many people in the hedge funds are MBAs or they have business degrees and they don't believe in marketing.
Right, this
I
is
mean,
the
traditional marketing like
Correct.
every other business in the world.
correct. And that is exactly what we're trying to say, is you need to do marketing, you need to build your brand. Like Goldman Sachs works with organizations that already have capital markets brand. Goldman Sachs has amazing relationships. I wouldn't argue with Goldman Sachs relationships. Why does Goldman Sachs do that? Because those are the companies and organizations that they know they can raise capital for, because those are the ones that have capital markets brands. And we're saying that is what, exactly to Marty's point, that's what this alternatives industry has to move to, we believe, to be successful for long-term capital raising.
To what extent is the independent sponsor industry or organizations valuable to these types of investment opportunities? Is it a source of investment that you could look at specifically because you don't put the money up until you have the deal, as opposed to putting the money into the deal, waiting for a return?
So independent sponsors, if people don't know what independent sponsors are, it's kind of the structure that's taking the place of a lot of private equity funds, right? So you have people who go around and identify a deal and then they raise capital for that deal. And so theoretically, the capital provider is no longer paying the fund fee, they're just paying the independent sponsor a deal fee to manage the deal on an ongoing basis. So there is carry, but it's not exactly structured the same way that fund carry is structured. And so independent sponsors have had like a very, has been a very niche corner of the market, and really sort of is no longer a niche corner of the market. And now business schools have classes on how to become an independent sponsor. And so we kind of think that, if a newly minted MBA comes out of business school and is now an independent sponsor, how well are they going to know how to run that company? But that's a decision for the capital providers to answer. But yeah, I mean, I think that the capital providers, a lot of the capital providers are trying to move outside the fund structures. And when they move outside the fund structures, they are looking at these independent sponsor deals. That is an
Yeah,
option,
it's an option, and certainly co-investment has become a bigger topic of conversation. We get that question a lot, will there be co-invests, et cetera. And, obviously if there are, they would have preference to the investors in the fund. And since this is a family office group, I'm gonna come at this a little bit from a family office perspective. We don't do any traditional assets, right? We're all, the family office portfolio is fully alternatives. We don't do long only fixed income, traditional fixed income, and we don't do long only equities. Because the view is we're in the stay rich business, not the get rich business. And going back to the issue of structure, right? People get very confused about alternatives, and there's still sort of a stigma that alternatives are riskier, right? And that comes back from long-term capital, which Marty mentioned, and Madoff and different structures that existed. But I think from the perspective of as a family office investor, when I look at long only equities, right? The long only equity guy for the most part is mandated to be fully invested, can't short, and can't be in cash. So the best that long only manager can do is rotate out of the worst performing sectors in whatever his mandate is. The long short equity guy, in contrast, has a lot more hours in his quiver, might not use any leverage at all, right? So if you have a technology fund on the hedge fund side that can go long and short and can be in cash, versus a long only technology fund that's mandated to be fully invested and can, as I said, only rotate out of, what's the riskier bet? To me, the hedge fund manager is better incentivized because he's paid better. So it's generally smarter minds. We had a risk officer at the fund that we sold, and he said, look, I came from the long only side. The best year I ever had, I beat the benchmark by 400 basis points. I was still down 12. I'm happy to, if anyone here in this room, and there's always the question about fees, right? If you could invest in Medallion, which is Renaissance flagship product, which has no outside money in it, but you were getting 50% net returns, would you care if you're paying 5 and 50? I wouldn't. So, that's another thing I would say that we look at, that we come at from the perspective, we count our net dollars at the end of the day. We don't count how much money the manager's making. As long as I'm happy with the net returns I'm getting in my portfolio, with the level of risk that I expect to have in my portfolio, I'm thrilled. Become a billionaire. You know, I'm riding along right with you. And I think sometimes people get caught up in this fee conversation and it gets twisted.
I think it's a little, I think it's a little more
Going back to
complicated
the
though.
independent sponsor thing, we don't do that.
I think it's a little more complicated though.
Pardon?
I think it's a little more complicated because I think that the issue isn't whether the manager is generating a 50% return today. It's whether or not their 50% return is sustainable.
Of course, you have to look at it over a period of
lot of
time, but
guys who
obviously
just-
Medallion
I mean-
has had that. That's why I use that as an example.
You know, what was, Bill Ackman's performance after, 2008, or what was, Einhorn's performance, right? I mean,
Well, that's
all
also
these
why,
guys fell to earth.
but that's also why you want the liquidity aligned with the underlying investment, so you can make changes in your portfolio, as you see needed. But, so for us, we'll do individual investments if it's a manager we're invested in, but we don't do just one-off sidecars at all. We just don't think we're good enough at doing that, and I think it becomes hard sometimes for people to turn it around quickly enough to work on both sides.
I'm seeing a lot of asks for what they're calling programmatic capital, so especially coming out of the insurance companies where they're not necessarily want to go into a fund, there's some restrictions
Yeah.
that they have. If some will invest in a fund, but they have to put like cash on the side, 40% of cash on the side.
It hits the balance sheet hard.
So that is becoming more attractive for groups like, they'll set a terms of what can be invested in, and they'll just be like a capital call, but they're individual vehicles.
Well, insurance companies want separately managed accounts because of the capital charges to their balance sheets. I've worked at an insurance company.
We've got about 15 minutes left. Is there any way we can talk about like what are the strategies that are hot right now that you see as being very desirable to be in?
We would love to. We'll start with Mary Beth. She has some really cool strategies
Yeah,
investments
so-
she's been working on.
Castle Hill, we like the niche strategies with a good story. So many of you heard Semper Farmland story yesterday. Farmland might be one of my favorite strategies. There's 150 years of history showing that it's a safe harbor investment. There's cash flow, there's sustainability, it's a limited supply. I mean, I can go on and on and on, and the Semper team is very good. They have the edge of coming out of Louis Dreyfus and understanding the commodity markets. So I haven't seen that with other farmland strategies to the degree they have. Talking about commodities, that has another big hit at Castle Hill. We've raised money for a broad-based fundamental strategy. We have a Texas Power and Natural Gas Fund that we've brought to capacity, a Metals and Mining Fund that has been brought to capacity as well. Private credit is just what everybody's calling us on. So we have had a few deals there and some specialty finance. And there's some, good, we have yes.
Do you think that the difference in private credit returns right now are impacting people's desire to invest in equity strategies? Because private credit returns are so high?
I think so, and the opportunity set too, with the banks are not lending, everybody wants real estate debt. I call around and my real estate expert doesn't think you should be investing in real estate debt right now, they think it's overcrowded. But that's, every family office I talk to has that on the table, it's something they're looking at. And real estate in itself is a huge, there was a lot of panels on it the last 2 days, but we're seeing a lot in industrial, we're seeing a lot in multifamily, but hospitality has taken, a downturn. Commercial has definitely had a hit, and we actually had a fund approach us recently on a distressed commercial fund about raising for them. I tried to get them to come to the event, but they were unavailable.
I ask people to speak up. It's impossible to hear down here. You're speaking to a coterie of people at the top of the table, and this is a long place.
Sure. And our female voices are
Exactly.
carry as well. But
I know Bobby and his harem.
yeah, we're like on the
Blonde hair.
on the call, we
saying
spoke
Charlotte's
about
Angels.
District Return Fund on Broadway. That's been getting a lot of attention. They're investing in West End and Broadway shows and the distribution of rights of the materials that come out of that. So there's a lot of interesting things out there.
To what
Cannabis
extent-
lending.
To what extent have you looked at life settlement as an alternative investment?
I've done some work on
That
this.
doesn't correlate to the stock market or anything else.
Yeah. We have a fund that invests in that. I remember one manager came in when I was in-house at Lucas Capital, and his track record was straight up. And I said to my boss, if your record looked like this, I would be doing a lot better. You know, we had a good chuckle about it. But it's really an interesting market. And even you can even do like the litigation financing and
Another
Medicare and
fund,
whatnot
yeah.
is all really fascinating.
You really have to investigate thoroughly into each of those avenues because even Life Settlement had a negative history initially
Mhm.
because people really didn't know what they were doing and made incorrect decisions on underwriting,
Right.
and that kills you.
So I guess, you know, I was just saying, so what we're like, I mean, look, we run a broadly diversified portfolio in the family office. And so, as I said earlier, we invest in everything from private equity to long-short equity. But we're particularly excited about credit right now. We haven't been in quite some time. So, and we do think this is gonna be a really good vintage for private credit. I think you need to be careful with who you're investing in the private credit space. There are underwriting standards and then there are underwriting standards. And it's very, very broad in the private credit space. And so I think you really want to look at that and you really want to make sure you're not investing in a pool that might have legacy issues or things like that. We do think this is going to be a protracted downward cycle. So we're definitely in a more defensive mode than we might be, despite what the stock market is doing and what the fixed income market is doing. Like if you think of the average high yield bond is only 89.5 right now. Like that doesn't feel right to me. There's a lot more downside here, but we think it's gonna be a protracted cycle. We think sectors are gonna get hit one by one by one. So we think there's gonna be a lot of opportunity in that space. And then, you know, we do look at nichier things. We have not spent any time really on life settlements, but we're trying to be very opportunistic but defensive, given the environment. We do think, we are very worried about the downside.
I mean, I guess we're believing that the FOMO cycle is changing from private credit to more clean energy. And, you know, obviously the US government is spending several billion, maybe $1 trillion on clean energy infrastructure and whatnot. And we think that that's probably the next trend is, you know, looking at how does the US build out its infrastructure to be more relevant in, you know, a cleaner, do you want to say cleaner environment? We think a lot of the private capital credit has been allocated at this point, and there are a lot of big funds out there that you know, don't see as many opportunities as they thought they were going to see. And if interest rates start coming down, you know, that, like I said, we think the wheel is starting to turn. In terms of more alternative things, we have some like insurance company opportunities that create very high tax advantages for family offices. We have some life settlement opportunities. We have some sponsor opportunities. We have some like medical device opportunities in companies. So we work both across funds and companies. We see some, we do see some real estate, private credit types of opportunities, but we're, you know, like I said, our feeling is that probably in the latter cycle, part of that cycle, because we're seeing less opportunity in those funds than one would have thought that they would have seen.
Just on your point, the work I do with the government and the military, I mentioned yesterday, DARPA, there's a lot of money, as you said, clean energy, a basic example, the amount of electric cars, Teslas and so on is increasing, but we all read about the infrastructure needed to just charge the cars periodically. And then we have a couple of pretty big deals on the battery side in Wisconsin and other states. So clean energy, we see the combination. I think Suzanne mentioned the co-investment opportunities where there's going to be some great potential. Converting former coal power plants where the infrastructure for the transmission distribution is right there to new kind of energy sources. That's some other exciting areas. So I agree. I think it's a very hot area.
What kind of energy sources are you talking about?
We could talk about that offline, but as I mentioned yesterday, next stage, nuclear, that's clean nuclear without the waste issues is a big issue. But even the batteries, without getting too much into it, I've worked for Con Edison for 10 years. They generate the DC power, but we use AC power here. So a lot of Tesla and Edison discussions about that Andy and I were talking about just on NG issues. So
I guess I'll reduce that to a question. There's things that are very investable today in that if you start slicing energy transition. And it's a question if anybody's have seen something about nuclear is really either government backed or regulatory. So push that aside. But there is things to do.
Maybe I can rephrase the question.
Again,
So are you saying, so, there's this reshoring that's happening, number one, and obviously the defense aspects, right? Do you think there's a lot of opportunities for investing like in infrastructure funds, manufacturing funds, defense-oriented funds? I mean, always been a problem with defense in that everything that comes out of defense is overvalued, right? Right, so it's defense-oriented funds, people who cooperate with like InQtel or DARPA. Your thoughts?
Yeah, I mean, I definitely think there are opportunities for that. I mean, I think, as in all things, investors are looking at the risk-adjusted return, as Suzanne says, but basically, I think that, the fact that the government is so involved in the economy these days, that, investors are wise if they take advantage of that, let's just put it that way. And part of it is probably upon the capital seeker to make sure that they're explaining how their strategy is advantaged by what the government is doing. But it's an incredible amount of money that's being pumped into this area in the US economy, into the infrastructure area.
We've been working with a solar fund that has really been taking advantage of a lot of the government incentives. And the commodity manager we work with, the broad fundamental commodity manager we work with, has an office in Oslo, and that's really where a lot of the energy transition is stemming from. It's really become the hub.
You have to make a point. We're involved in some things that the government should be involved in, et cetera. And we're finding, we see a lot of lip service, but we don't see a lot of delivery. It's almost like, during the economic crisis, they talked about all the money they were throwing in the economy, and that money didn't go in the economy. That was sort of and I believe there's money going in, but I just really believe that somehow the government speaks out of both sides of its mouth. They say they're doing this, and they don't really do it as much. Are you finding they're doing it, or?
I think that's just politics in general.
I'm sorry?
In politics in general.
Politics in
But
general.
what kind of
That's what I'm
opportunities, what kind
saying.
of opportunities do you have that they're not getting the attention that they
Well,
should?
Peter knows, we're in rare earth, and we got an amazing situation, and we're in processing for mining, and they talk big games. I literally have the Defense Department at my apartment,
Right.
saying, we need you, and, make sure you only have US investors. And yet I say to them, what are you doing to help me? Okay, you want me to only have US investors, I have a lot of interest, some foreign investors, and it's very frustrating, and Peter knows a little bit about that, okay? And I'm trying to get some money out of DARPA. We're gonna announce in 2 weeks that we have the finest processing for mining in the world, created by National Lab. The government is all over it, but not writing any checks, all over us.
Well, I know a little bit about
That's
the
an
process.
example, don't
Yeah,
get me
I know a
wrong,
little
but
bit
it's
about-
frustrating.
I know a little bit about the process, not a lot. But obviously, they have to give out the money under RFPs, right? And they also.
So what?
Under
RFPs.
RFPs. And they also, what they've been doing is they've been dividing the money and they've been sending it down to the states as well as, so just because it's federal money doesn't mean it's being given out by the feds.
That just tells me, forget it, next year.
Well, this is
When
the
it goes
point.
down to the states, you know what I
Yeah,
mean?
there's a
Let me
process.
address that.
It's just so much lip service.
Let me address that and you, both of you, because
Sorry?
I want to address both of you. Sure. Because you're right. You have to determine on any of these projects that the government is providing capital for, why are they providing the capital for that project? For instance, we were approached with a project to suck carbon out of the air. Now, we have an organization, a company that has a better product to do that. There's only gonna be 5 or 6 companies that are gonna bid on that contract and get that contract. They all happen to be related to the Democratic Party, and that's a way to pay them off. Let me tell you something, sucking carbon out of the air in the United States with 330 million people, and you got 8 billion people in this world, that's a payoff. That's all it is. So you really have to determine what's the reason for the money and what are your chances of getting it? That's the answer.
We're in clean water. One of my companies created the pure filter for Procter & Gamble, so we created a new, totally revolutionary. The EPA cut back on funding on water. Why would they cut back on funding on clean water?
They did.
Yeah, I mean, I think the discussion on government priorities is probably better for another
Sorry,
day.
I would like to table that discussion, and instead of what I'd like to do is talking about the impact of duration and return. Right, so a lot of people say, well, invest in my a private equity fund, my hedge fund, lockup on private equity is 10 years, 7 years, we can go to 13 years if we want, right? There's some co-investment, but then you get a credit fund that says, hey, our average duration is 24 months. The lockup, in some cases, we're doing 9-month loans and the lockup is a year, right? And then you have to just tell us to recycle your money, right? So, I mean, it's so much of an easier decision than to have your capital locked up, right? And plus, everybody knows that despite what people say that banks have pulled back on certain lending, right? So,
Well, I think banks have pulled back. The pressure on the regional banks and what's gone on there has obviously created a big vacuum, which to some extent will be filled by private credit guys. But the new regulations that the government's proposing, thousands of pages of, explanation of these new banking regulations, could really hurt the banking sector and I think make things even more difficult, which is why we don't think rates are going down anytime soon. In fact, we likely believe there will be continued upward pressure on rates here, particularly since the consumer is out of gas. I made this point at another conference yesterday that, if you think about your average Joe, right, who leased his car 3 years ago, the car is coming up on lease. The current lease payment, if you can't afford to buy your car and it makes sense to buy the car, your lease payment might double if you have to lease a new car, right? That doesn't necessarily, I can go buy my car if I choose to do that because it makes more sense, but Joe Sixpack might not be able to. And now he's going from a $350 a month car payment to a $700 a month car payment. Those things exist across the board. In terms of Marty's exact question about duration, I think again, it goes back to, does the structure mirror the liquidity of the underlying assets? So as I mentioned, 50% of our book in this new fund we're launching will be in less liquid, larger positions where we take this suggestivist approach to working with management and helping them restructure. Our historical experience has been that piece of the book turns every 18 to 36 months. The other piece of the book, which is more of trading, event-driven stuff, tends to turn once a year. So we structured effectively a 3-year fund with a 1-year hard lock and then visible liquidity going forward so that we can manage for those issues. And I think you want to look at that. I don't know if that answers the question, Marty.
Yes, that's correct.
yes,
I said, I don't know if that answers the question.
no, I said it does.
Oh, okay.
I have another question, but, I like Indian tribal investments. Especially politically oriented. So do you guys remember Stark Investments?
Stark,
Stark from
out of
Wisconsin.
Milwaukee, Wisconsin, yeah, of
Yeah.
course.
So Stark had
I
a
started as a
$600 million
convert trader.
fund just towards circumventing government regulation via Indian tribal lands. I mean, they had other problems. They failed because of their hedge fund trading, right? But the Indian tribal land business was hugely
Leverage.
successful, right?
You had a gentleman in the Miami meeting last year that spoke.
And he spoke at also another meeting we had a couple of months ago.
Yeah, because some pharmaceutical companies took their patent portfolio and assigned it to an Indian tribe to get out of being sued and so on. That was a major deal. And that gentleman spoke about that, was familiar with it. So.
I mentioned last time, and I'll just quickly mention, the Seneca Indians have their own independent state between Canada and the US, literally as a country, because they didn't move. They were not a reservation. So we tried to put medical tourism there. One chief loved it. Next chief didn't like it. And they replaced chiefs every 2 years. So
Yeah,
I'm not poo-pooning it.
tribal nations are incredibly political. I mean, I lived it. I had a tribal nation was a client of mine for 5 years.
I went to the inauguration of the new chief and kissed up and all that stuff, and he said he didn't like it anymore, so we were out of business. It's like,
I had a
it's crazy.
similar experience. Putting up a medical school in Indian lands and trying to get rid of the Indian service because it's desultory, it's horrible. The service they get from the government,
I'll take
the
their money
Indian health
anytime,
service is very mediocre.
Get into rare earths.
They should.
Yeah, I agree.
Dealing with the politics of which tribe gets what is one of the major issues that comes up. Which
They mimic the United States. Now we go after ex-leaders.
So what do you think about things like litigation strategies and you know, more intellectual property oriented strategies or you know, patents,
We,
funds?
we think those are interesting. I just think that it's harder and harder to have a true edge. There's so many people falling into like life settlements. You know, there are more and more funds that are doing life settlements, or people doing life settlements, or litigation. I mean, we've heard like 3 or 4 litigation funding funds coming to. So it's like these kind of niche strategies that had edges. We just think, and sponsors. And as that happens, it's harder for the quality to stay high. So we think they're valid strategies. It's just as it gets more competitive, it's harder for the quality to
I
stay
think
high.
what you're saying is actually capacity matters.
Yeah.
They need to have a certain niche.
I'm right here.
We've worked with a couple different litigation
I
funds.
need the door closed.
I've invested in, and
Thank you.
they're focusing on, one's just doing a very specific Medicare collection.
Yeah,
case.
let me see.
And that seems to be very successful and high returns.
Yeah, Burford, the CEO of Burford was on 60 Minutes last year talking about the investments from private equity into litigation funding and the success, amazing success they've had. But I agree, they've picked some really good cases. Fortress Capital, who we work with, just raised a new $2 billion fund just to invest in some intellectual property litigation in the chip area because of so much money in that space. And Intel has been going to Congress just to protest all the private financing going into litigation against them and many big companies.
Hey, Peter, I was on with Burford on Wednesday of last week. I didn't know the strategy is the law firms got to do 50% of legal fees. They insist, all of them do, and then they'll put up some money. So you got to get 2 parties, you almost throw them in a room and let them fight it out. But the law firm's got to take a deep discount, and if they don't believe enough in it, they won't do it.
Kevin, so to this point, and Peter's, there's literally 8 slices of litigation finance, and you need to choose. People doing class action lawsuits, people doing intellectual property, that's not the same business.
Not at all.
And if you're talking about a strategy, the strategy does matter.
Yeah, to Mary Beth's point, is privacy litigation in California is enormous. And I don't know all the details, but my colleagues are telling me they changed the laws last year,
Completely
and there's major class action cases going on there.
We've got about 3 minutes.
I had a client that was doing divorce litigation.
I mean, I think those are really
Not the
interesting
funds
areas,
and
but I
grants,
think it's like
yeah.
anything else. You really have to pick your jockey very
Yeah,
well
yeah.
in any one of these spaces and figure out what their edge is in the specific vertical of the litigation finance or life settlements or whatever it is. So I think it's really understanding the expertise of the manager that you're anointing to manage that part of your portfolio.
Essentially.
One of the things I look for is scalability in reference to anything we do. How can it be scaled? How can you increase valuation? And what's the beta component of that? In every situation.
Can I just ask a very simplistic, dumb question? The co-investor yesterday on one of my deals says to me, he says, no one ever invests anymore in early stage businesses unless they get a preferred position. I said, well, we all have common, and I'm happy with common, I'm KISS. Do you have any feeling about that statement he made to me? Is that,
It's increasing, but it's
am I
not
in
every
warp
time.
or something?
It's pretty common.
It's
Sorry?
pretty common, yeah.
It's pretty common.
Common's the first round, keep it simple, correct? Am I
Well,
mi-
first round, are you
I don't
talking
know,
an
I
A round
think,
or
I
you
mean, I
talking?
just, somebody showed me a deal that this week that I led a small startup and, you know, it's a 21% preferred common. That seems to be.
21% what?
21%, it's a preferred, it's equity, but it's preferred, and it's got a 21%
Is that an
dividend.
A round?